Portfolio Builder members, today is August 15th and we're coming off another large profit playing the TLT for income. So we'll take a look at last week's trade, how it panned out, and look at the breaking news this morning that's helping us create today's new trade alert. Here's the summary. And this is again a trading week where we could have made a lot more money if we didn't have all the protection on our trade, but this program's not about growth, it's about safe, consistent income with very little risk. Sleep like a baby trade alerts. And so we can go back to last week's trade and see how we put it on. It's called a collar trade. Makes it so it's hard to lose money, but it also reduces how much you can make. And so our setup was profiting if the TLT climbed higher. And you can see what we did was we sold the August 16 140 call for 83 cents, credit to our account. And we took half of that credit and we purchased a put option at 137. And so if yields were to spike for any reason under the sun, we would be able to get out of the TLT for a minimum of 137. On the other hand, if the TLT flew higher over that week, our profits got cut off at the 140 plus 83 cents. And so we put this on when it was trading at 138.99. So here's a summary of what happened from the trading period. The TLT climbed from 138.99 to 146.42. That's a gain of 743 on the underlying asset. Now our collar started off as a credit of 43 cents, but we had to pay back $6.50 to get out of the collar. So that gave up $6.06 of our profit. Meanwhile, we took part of the potential profit and we bought a bull call spread on GLD. That cost 49 cents to enter the call spread, and today we walked out with a 93-cent credit for a profit of 44 cents. Overall, we had a profit of $1.81 per share of the TLT, which is a 1.3% week-over-week gain, or an annualized income of $9,412 per $14,000 invested into the TLT. Now, we're not trying to hit that sort of return every week, and I don't want you to think that's possible, but this portfolio has had a very smooth profit week over week for almost every week this year. The TLT has had very little drawdown, and we've been consistently selling call options to buy put options and generate income. So this has worked out very well. Here's a look at our new return. And I can't show today's trade alert in this video because this is public on YouTube, but if you have any questions and you're a member, please feel free to ask it in the chat box. That's the purpose of this live chat. And also to get you the breaking news. So for those of you who are a member, you'll have today's trade alert and be set to jet for the next week of potential income from the TLT. Let's take a quick look at our portfolio returns and then we'll jump into the breaking news of today. We do have a live webinar hosted via Zoom where we can talk out loud. You can talk, you can hear everybody's voice. So if you're planning to join us for that, that's coming up in about 50 minutes, so I'll have to keep today's live stream a little shorter. Our equities portfolio number one, which trades the SPY ETF, is up 9.4% total return, and that represents 40% of our total portfolio. So this trade is much less risky because it trades Monday, Wednesday, Friday. It takes advantage of the only option market that has 3 expirations a week. And again, it's smaller return with ultimate safety. On Tuesday, we do a more risky trade that aims for a higher return, but it has a higher risk. This is currently 12.8% of our total portfolio, and it is up 19% year to date. It's done extremely well. Right now, it's playing the silver ETF, which I think has a long ways to go. We have a buy and hold portfolio that has been growing over the past year as the central banks have become more and more accommodative and lowering rates The next move we think is that they're going to start buying up government debt and inflating the monetary supply to avoid a credit crash. So the corporate credit market is definitely extended in America as well as in China, and that's the big risk facing a lot of these markets, including European banks like Deutsche Bank getting at very scary levels. And then meanwhile, we balance out the whole strategy by having 40% of our assets playing the bond market, which is what we do with the TLT, and that's what today's trade alert is all about. I'll look at the combined return. If you were following all of our trades exactly, you can see just how smooth our returns have been. December, we had 1.17, and that's during the Christmas massacre, where people lost a fortune and freaked out and sold at the bottom. January, we had 2.19, February 1.75, March 2.74, April 1.19, 2.23 in May, 3.21 in June, our best month. July was our only loss with a negative 1% return, and so far in August we're up 1.63. Now that is, again, if you combine all of our strategies. If you're only trading the SPY ETF, here's the return we've offered, and this is what we give out during our free trial. Now, if you do click in the description box below, you can get access to our track record, to our free trial where you can try out the trades free on the SPY for a week. Doesn't include the Tuesday trade or Thursday trade during your free trial, but whenever you do upgrade, you will get a 30-day bonus to try out the whole program. So the SPY, we had 0.5% return in December, which is remarkable considering the drawdown that equities had. January 3%, February 2.6, March 1.5, April flat. May we lost 1.25. June we were up 3.44. July we had another loser, 1.1. And August has been a little slow on the SPY. I've been looking for drawdown in the SPY and we've caught it, but it's been a wild ride up and down in the SPY. So far we're up 0.25 of a point on the SPY portfolio. Now the Tuesday trade, again, only trades once a week, also at noon Eastern. All of our trade alerts always come out at noon Eastern, followed by a live stream so you can chat with me and ask me questions. The Tuesday portfolio has been a little bit bumpier, but it has a much higher return, which is the goal. So it lost 4 1/3 on December, picked up 7.6 in January, 3.5 in February, 3.9 in March, 1.5 in April. We had losing months in May and July of 1 1/3, but June had an outstanding 6% gain, and so far in August we're up 2.4. Now this has done a number of strategies. Primarily it's traded Apple and then SLV, the silver ETF. So that's been the bulk of our trades. Recently, in the month of June, it was buying and holding a basket of the top stocks that the SPY ETF purchases. So it tries to mimic what the SPY ETF does on a weekly basis, holding the actual assets of the SPY. But right now, it's playing SLV, which I think has a long run up, and it's turning the SLV ETF into an income machine. We're not trying to get growth from these strategies. We're really trying to generate consistent income with safety of capital. Now, we've been slowly increasing the recommended allocation to our buy and hold precious metal crypto portfolio. And so currently this is at 10% of the total portfolio in terms of our recommendation. And you can see it's had a wild ride, 27% total return in December, only to give back half of that in January, only to return 21% in February, 10% in March, 26% in April, 60% in May, 9.5% in June, -11% in July, 3% in August. And now we're looking at our TLT portfolio. This has been a slow, steady, boring, very repetitive and predictable trade alert. 2% in December, 7.76% in January. We had our only losing month in this portfolio in February, which is surprising because that's when the Fed was becoming dovish. 3% in March, 0.5% in April, 1.7% in May, 1% in June, 1.29% in July, and a very strong month for the TLT in August, 2.47%. If we look at the individual track records, you can see the SPY. We have our buy and sell history right here. We have our option writing in this section. And again, if you do want to check out the track record, go to the description box. You can check it all out. Also, all of our emails have links to the track record. And this is where we're hedging with the put options and long options over here. So if you click down here, you can go through our different track records. Not a lot of trading in the buy and hold portfolio. This is actually up about 200%, but I've been adding capital to it as the picture has become clearer and clearer that the trade war is not going to be resolved, that the central banks will have to print more money, and of course this is very bullish for inflationary protected assets like gold and cryptocurrency. So crypto's down to 10,000. I would say that's a great buying opportunity. A bunch of people had to sell just recently, but the reason to be long these assets has never been stronger. And unless the US-China trade war de-escalates, we may be slowly increasing this up to potentially a 15 or 20% total portfolio. But we're also playing these precious metals in our Tuesday, Thursday trade to help get some extra profits from the income side of our strategy without having to hold all the risk of these assets. And in the grand scheme of things, the gold market's only $6 trillion in value. I'm not sure what the silver is. It's much less, and Bitcoin's only a $200 billion market cap. So the point is these assets can be easily manipulated, and they are. And so for now, we have the manipulation on our side, but that could flip on a dime if the US-China trade war were to de-escalate. If we go to the Tuesday trade, we call it the SPY alternative. Some people don't want to trade the SPY 3 times a week, so this trade can replace that, or it can actually add a little extra return depending on your lifestyle. And so far it's up 19%. This is one of our best performing income strategies. And again, it's not doing this with buy and hold. This is doing this with call options that are sold above the asset and put options bought below. So we're giving up a tremendous amount of the profit to provide security and turn this into an income strategy instead of a growth strategy. Now, Thursday has had very few trades on the equity side. It did rotate into Amazon and Google for about a month when they were at a significant discount. Other than that, it's been just playing the TLT, and quite frankly, we've had to give up a huge amount of the profit because the TLT's gone up so quickly. From every time you can see a closed ROI that's negative, that's when we had to give up some of the profit. It's not when we lost. That means our underlying asset generated the profit, and we gave up several dollars in each of these different trades. So if we had been going for growth, we would have done even better. But again, our members are not interested in growth. They're interested in safety and consistent income. So this portfolio is sitting on 12.79% return. Now, if you are interested in upgrading or starting a free trial, please call Dean and gain access to all trade alerts for only $9.97. You'll get a 30-day bonus to receive our Tuesday, Thursday trade. Normally, it's $19.97 a year just for the SPY trades. And many of our members will make that much money in the first month or less of trading. So you'll get to try out the Tuesday, Thursday trades where we add in the precious metals, we add in the bond market, and this really helps bulletproof your portfolio from any sort of risk by balancing half your capital in the SPY, half your capital in the TLT, and then putting a slice of it into the precious metals like GLD. It makes your portfolio weatherproof and extremely hard to lose, as you've seen with our returns. All right, let's jump into today's content. All right, so we're going through a bunch of content I've collected. And again, the link to this document is included in the description box. So if you want to go through this, please feel free to do so. Today, stocks are rebounding. There's a little bit of relief in the trade war and also strong retail sales in America. So just about everything's up except for the volatility index that we follow, UVXY. Here's a look at FXI. This is the Chinese large cap ETF. And in our Tuesday trade, we've been betting down on FXI. So we did pull off about a 90% gain yesterday on some FXI puts, and we still have a lot more to slowly let go. Some of them are up as much as 200%, and I think they can go up a lot further. So we've been bearish on the Chinese ETF FXI. And while we've seen a lot of metrics slowing down in China, America still remains strong for the most part. So the long SPY short FXI play seems to be working out very well right now. GLD continues to rally to new highs for 2018 and 2019, and this is a buy and hold play for our portfolio. We have been doing some bets on GLD in our Thursday trade as well that helped us double the credit that we received from selling calls against the TLT. So the big idea here is that the central banks are all going to be buying up government debt, expanding the monetary supply, protecting the credit markets as we watch this U.S. trade war potentially escalate as we get near and near the next election cycle. HYG is the high yield bond ETF, and this is something I'm watching closely. If the credit to the stock market gets crunched, that would stop the corporate buybacks, and that is definitely one of the key buyers of this stock rally. So that's something we're watching out for. I do suspect the central banks will protect these credit markets as long as they can, and potentially the only thing that could stop them would be inflation, which beyond housing, medical, and college has been muted. Okay, LQD is the investment grade corporate bond ETF, and probably the more important one. You can see this one's been on a steady incline, very correlated to the TLT, and this perhaps is where a lot of risk is held. A bunch of the bonds in this portfolio are barely rated BBB, triple B, and people like Jeffrey Gundlach believe that a huge segment of this ETF could be re-rated to push it into the junk bond ETF, and this could create some chaos. So we're closely watching LQD for signs of weakness for the equities market. SLV climbing to new highs. If we look at SLV on a longer chart, we can see it could go up to something like $40 in the last bout of inflation fears. And so this is a play I see us doing in our Tuesday trade alert, turning it into a safe income play rather than just a straight out buy and hold, as I think this can travel higher relatively smoothly until the trade war has ended, which there's no end in sight. SPY ETF we've been betting down on ever since Trump came out with the new tariffs, and so far that's been profitable for us. This has been the most difficult asset to predict, as it's been quite news sensitive, and it's hard to predict when Trump's going to make tweets. I've been expecting this sell-off since June, so that's been something we've been carefully watching and waiting for, and finally the tariff threat has come back into play, only to be reduced slightly with the whole pitch that they're going to push tariffs into past Christmas. Meanwhile, people are buying bonds as the safe haven, and The bond market's really acting very strangely now. In Germany, you actually have to pay the government to buy their bond. It's supposed to be the other way around. And if Germany is going into a recession, why would you want to pay the government to borrow money from you? It doesn't make any sense at all. And so the only reason people are rushing into this bond play overall is that they think equities are going to have low returns and they can make a profit by speculating that they can flip their bonds. So what happens when everybody decides it's time to sell the bonds for a profit? And that's why we got to have that put option below the TLT and then sell the call option above, because this could really implode on itself. Now, many people think that the Fed will have to protect the bond market and not let those yields spike as long as they possibly can. So we're closely watching this. The next big FOMC meeting is September 18th, and most likely they'll cut rates at least 50 basis points. If they do anything less than that, the TLT could sell off dramatically from disappointment. And in fact, it may sell off anyways, just as people start taking profits. This 30-year Treasury hit an all-time low below 2% yield. And it doesn't make sense. Why would you want to make 2% yield for 30 years on a bond if the Fed's goal is to push inflation above 2%? So clearly the markets are not working the way they're intended to, and this is creating a lot of risk in the market. It's creating a huge bubble in bonds and in stocks. Here's some look at the Chinese companies. They're doing well today. EEM is primarily China and its trading partners, but it does also encapsulate some other countries like South Korea. EWY is the South Korean ETF, perhaps the best leading indicator for the stock market in Asia, and perhaps also a leading indicator of what the total equity markets may do, because it's such a central hub, and it is clearly showing weakness. Now, this is the most alarming data today. With everyone else bouncing up, the Deutsche Bank DB is down 2.24%. Many say if it gets below 6, it could go belly up and create systemic risk through the entire financial market. And so this is due to the rates going lower and lower and making it impossible for these banks to make money, especially with negative rates. And we've got the Germany ETF falling today as well. So while we're all focused on the U.S.-China trade war, Europe is slowly going bankrupt. Here's a look at Deutsche Bank and EWG, the German ETF. China warned it would retaliate against the latest U.S. tariffs, but later followed up by saying it hoped the U.S. would meet halfway in trade talks. So we're getting mixed results from the trade war right now. July retail sales were strong. Walmart came in with strong earnings today, showing the consumer is still strong. There's the headlines on Walmart. The yield on the 30-year Treasury has gone where no 30-year Treasury has gone before, below 2%. Bitcoin is down, which is surprising with gold and silver going up. I would say this is a great buying opportunity. I don't think it'll be at this level for much longer. And this is all, of course, unless the trade war de-escalates. So we do have a clear relative de-escalation for about the next 4 months, because we've delayed about half of the 10% tariffs until December 15th. And some of those may not ever get tariffed, which might be something like cell phones to protect Apple. But in the same note, we're seeing tensions rise between China and Hong Kong. We're also seeing more news flow coming out against Huawei And so very interesting. Now, the tariffs caused China to devalue their currency, and then America came out and said, just kidding. So they perhaps devalued their currency for no reason, causing more capital outflows out of China. Here's a look at the Shanghai Composite, going nowhere for the last decade. Crude oil showing weakness. This will help keep inflationary pressures down, but will it help show that the market is, that the global markets are growing and that there's demand for growth? No. So this is all very bullish for bonds and for precious metals because it's going to allow the banks to continue to print and support these credit markets. The euro continues to weaken, and so the dollar continues to drive higher and higher, which could create a currency crisis as there is a very shortage of dollars around the world, which again is helping push up equity prices in U.S., bond prices in the U.S., and really crippling the rest of the world. Here's that critical level. Now that the tariff threat has been pushed a little bit down the road, we can see they've started to tighten up the conversion rate after it broke that critical 7 line. That created a lot of chaos. The German 10-year yield is a good leading indicator predicting the movement of the U.S. market. And you can see it's just free falling lower. That's why today's trade, as much as I wanted to bet down on the TLT, I've just had to stick to the trend and let the market tell me where it's going to go. So today's trade was bullish on the TLT again. And here is the key graph I look at to help make that judgment. And this is despite people most likely wanting to start taking profits on that TLT. But I think the overall pressure is continuing to mount. Here's that 10-year bond note for the UK, also in free fall. Some tweets. U.S. President Trump, U.S.-China trade deal has to be a deal on our terms. That sent stocks going a little bit lower. David Rosenberg, major reason for a meltdown in bond yields. We're back in a deep global savings glut. When investment falls short of savings, rates fall. It's that simple. And the rising level of uncertainty on trade and other matters too has caused capex worldwide to retreat. U.S. manufacturing slumps back into contraction. This was after strong retail data. So stocks are confused today, to say the least. Bitcoin back below 10K as $3 billion China Ponzi allegedly dumps crypto. Plus a bunch of people had to reportedly pay taxes. So I do think this is a short-term buying opportunity on that. Here's that Empire Fed that was up. China wants the U.S. to meet halfway on trade, reiterating the position Liu He communicated to Lighthizer in a call before G20. China's not doing anything to appease the Americans, so I think this is just a ticking time bomb. President Trump has linked trade talks with Hong Kong problem. It won't work. Even if he does so, trade war has dragged on to now. The U.S. has no more economic levers to pressure China. If Beijing determines to intervene, it won't worry about U.S. sanctioning Hong Kong. I think that's some baloney. There's a lot of things we can do to add more pressure. And we'll look at the problems in China in a minute with a great article out from Jim Rickards yesterday. U.S. consumer continues to drive U.S. stocks higher, or at least providing some support from the rapid sell-off this week. The bond king, Jeffrey Gundlach, he's made billions predicting the bond market. He's been bearish on the treasuries since the beginning of the year. So clearly he's been too early on predicting rising rates. 30-year UST is at its lowest yield ever, is being touted as a buy about as loudly as the 10-year was on July 6, 2016, when its yield troughed at 1.3. So we'll see. This guy pointed out yesterday somebody put a huge bet. He sold put options to finance a bull call spread on the SPY and could potentially make $3.5 billion profit if the S&P 500 rallies 10% by October. So there's that FOMC meeting. He's thinking that will save the day and rally stocks. And I think he might be right. So we're dying to go back long the SPY after we caught this down move. And this trade has a potential 4,400% return. It's crazy. Today is the day Trump may start to realize the real economic consequences of his trade dispute. He's likely felt like a wizard until now, likely to be a bit eye-opening for him. Additional tariffs are mostly going to hurt U.S. consumers, not China, because of this. I see little chance of implementation. For the most part, he's already done all of the easy things and hasn't extracted a lot from China. I am only saying that will be an eye-opening realization. Here's some data on the returns after the inversion of the 10-year, 2-year that everybody's freaking out about. And so some pretty high 1-year returns on average after these most recent events of this. This was a nice video from Real Vision. 1-hour video just came out. He's going to be putting out a bunch of videos. Again, you can get these links and watch them on your own time from our document. Here's some of his basic ideas that he thinks that we're going into a recession and that you should be long bonds, gold, and Bitcoin, and not long stocks. I think that he may be missing that there's going to potentially be a huge rally in the SPY because so far it's the best equity market to go to, and bonds have limited room to go much higher because we're getting close to zero. So he likes to look at this equity, and it just in general shows slowdown around the world in a lot of different metrics. So I won't go into too much detail, but just about everything is slowing down. Housing is slowing down. And he does point out that the unemployment is a lagging indicator. So even though that continues to push lower and lower, he's more interested in the leading indicators. World PMIs are in negative territory. Trade volume is slowing down. And this is with everybody trying to rush and beat the tariffs. So that's been potentially helping push equities higher by having strong GDP, because everybody's trying to build up inventories to beat these different tariffs. South Korea exports in negative territory. GDP is falling. The yield curve inverting. And now this is looking at 2007 before the big crash and 2000. New York Fed's recession probability. Every time it's gotten above 20, we've had a crash. And this is his biggest concern, is that he thinks the U.S. corporate debt has become too high, and that this is what will eventually cause a stock crash, is that their credit ratings go down, they can't get access to capital. But I think that the Fed is going to lower rates so low that this is going to create a huge bubble, and that we're going to see not only the U.S. bonds go up, but also the U.S. equities market. And that's if the trade war doesn't get out of control. So we'll have to keep a close eye on that, because the markets are clearly very sensitive to news related to that. Also, the corporate buybacks has outweighed everyone else selling stocks over the last few years. Here's a look at the big chunk of the triple B rated stocks, which are in that LQD. So he thinks, and this is actually a Jeffrey Gundlach prediction, that a lot of this triple B will be downgraded, and that could really upset the corporate bond markets. Here's the primary holders of the debt. AT&T being by far the biggest. Debt to equity ratio, Ford having the worst. So these car companies have had a lot of trouble in the past as well. Tax receipts having drawdown, and this is at a time when we're creating more debt than ever before. And here's kind of an outlook of what he thinks will happen. Triple B credit downgraded to junk. Debt market freezes. Pensions will sell and take losses. Baby boomers need to start selling assets to fund their retirement. And so phase one, business cycle weakens. Credit spreads widen. Corporate cash flows slip. Equities fall. Volatility increases. So he's saying that's what we have right now, although I'm not sure that the corporate earnings have really slowed down yet. So I'm not sure if we really completed phase one from his look. Looks like phase two didn't come in. Phase three, baby boomers start selling stocks. So he's saying that the baby boomers have been trained to buy the dip, but now they're going into a period of life where they need to play it safe. And so they may start selling dips and selling rallies. And at the same time, credit gets locked up and the corporations can't buy back their own stocks. And so eventually he says equities completely collapse. And that's why he's long bonds and then long gold and Bitcoin. Northman Trader, imagine how pissed you'd be if you were worried about markets selling off and you announced a tariff delay to juice things up only to see new lows and a crazy inverted yield curve instead. The 50 basis point cut could happen next week in Jackson Hole. So we got all those Feds meeting in Wyoming. The Fed fund market is rarely wrong about the next FOMC meeting. And so just showing the probabilities of rate cuts. The bond rally goes until the Fed cuts 50 basis points in September. When the Fed gets aggressive, rates rise and the curve steepens. Until then, rates continue to sink and the inversion grows as the market prices in economic slowing, recession, and the Fed too slow to respond. This is looking at when the SPX has been down 3% for the second time in 8 sessions. What were the outcomes? And so in general, the market goes up, so buying the dip works. The question is, can the earnings stay strong and can the trade war de-escalate? Will the Chinese want to push this harder into the election? So there's a lot of uncertainties that we have to deal with here. We are winning big time against China. Companies and jobs are fleeing. Prices to us have gone up or have not gone up, and in some cases have come down. China is not our problem, though Hong Kong is not helping. Our problem is with the Fed. Raised too much and too fast. And also, that's another thing in the Real Vision article. Even though they only raised to 2.5, the rate of change that they raised the rates was faster than ever before in history. According to their video. So that perhaps is what's caused a lot of pain in the markets. Spread is way too much as other countries say thank you to clueless Jay Powell and the Federal Reserve. Germany and many others are playing the game. Crazy inverted yield curve. S&P 500 tends to peak 7.3 months or 2.5 months median after the 10 and 2's curve inversion. So I was pointing out all these times it's happened. And so the joke is that it's predicted more recessions than that have happened. Wall Street Journal saying Huawei is spying on government leaders in Africa. So that's obviously not positive for that. I'm going to go ahead and save the last article for tomorrow since we have our live webinar coming up. And that is a big piece from Jim Records, really good, talks about China and how they've created they've created more debt than America has created in the last half century, in just the last 10 years. And so that's why China could implode and really hurt the global economy. So we'll save this one for tomorrow. And if you like our content and want to try out the program, call Dean. Gain access to all trade alerts for only $9.97. It's normally $2,000 a year just for the SPY trades, which is Monday, Wednesday, Friday. It's a 2-minute trade at noon. Right after we do the trade alert via email and text message, we jump into the live stream so you have access to me. We also do live webinars where you can actually talk out loud. That's what's about to happen in about 15 minutes. So if you'd like to do that and take advantage of the 30-day bonus to our Tuesday, Thursday trades, call Dean right now, 505-322-7515. And I'd also like to invite you to subscribe to our channel and click the little bell. If you do that, you'll get announcements when our live stream is going to happen, so you can join us live and get the most out of this YouTube channel. So thanks again, and look for a new live stream tomorrow right at noon.